I don't believe that I could give a good answer to where rates are going, but I can give a good answer to what will happen if they go up.
Hello, hello, hello. This is Tom Wheelwright filling in for Robert Kiyosaki today. You're listening to the Rich Dad Radio Show, the good news and the bad news about money. Robert is in Australia, New Zealand, speaking down under, and I get the great privilege of subbing for him and learning along with you from an amazing guest. Bob Prechter came up with the term socionomics and is recently written a new book called The Last Chance to Conquer the Crash. And this is something I know Robert talks a lot about, crashes. And I'm so excited to have you on the show, Bob, because you're going to help us know how to survive and prosper in that crash. And hopefully you'll tell us when it's coming. So, Bob, tell us a little bit just about your background and why you decided to study this issue.
Oh, well, I started in the Wall Street area in 1975, working under Bob Farrell at Merrill Lynch's market analysis department. Left in 1979 to go out on my own and start the Elliott Wave Theorist, which is a monthly publication I've been putting out ever since. And we started something called the Socionomics Institute about 15 years ago to spread the word on a theory that I have that waves of social mood are in charge of people's moods in society. And those moods really regulate just about everything, where the stock market is going, the health of the economy, the style of music people are listening to, fashions that women are wearing, and so forth. So once you're tuned into the waves of social mood, you can kind of connect all kinds of things happening in the culture.
I'm so glad you're on the show then, because we've seen a really interesting situation going on where you have the markets just rising, all the markets. I mean, you've got gold going up, you've got oil going up, you have the stock market going up, and you have cryptocurrency going up all at the same time. And you've talked about extreme market conditions in the past. Let's start right off with the hard stuff. Do you think this market is overvalued, or do you think there's a ways to go?
I think it's crazy overvalued. It's historically overvalued. It's equal to or greater than the overvaluation of 2021, far higher than the overvaluation of 2000, for example. And you're absolutely correct. There are several areas where there are manias happening. They're narrow, however, which is very interesting. In the stock market, you've got a couple of indexes at new all-time highs, such as the Dow, the S&P, and the NASDAQ, propelled by a small handful of tech stocks. Everything else is lagging. You've got the Russell 2000 index, for example, which is still down 16% from its high 2 years ago. Now, you've got something similar in the real estate area. You've got housing holding up pretty well, while commercial real estate is plunging. So that's very selective. You've got Bitcoin at a new all-time high and maybe one or two others acting well, but the vast majority of cryptocurrencies are down, and they're way down from their previous highs. So these manias are very narrow, but they're extremely intense.
So, this is your study, right? Is studying the manias. So what causes this kind of mania, and why now? I mean, you would think, yeah, I get we had all this money put into the economy during COVID, right? The government put in trillions of dollars into the economy, but that's got to be running out. So what's causing this mania right now?
Well, I think manias are the cap in a natural progression of positive social mood. Now, you start in times when people are pessimistic and they're negative and so forth, and it takes a long time to get to the opposite extreme. Now, we passed previous historical extremes, such as we saw in 1929 or 1966, 68, or any of those years, by a very large margin. And we can talk about some of the indicators that tell us that. So I think there's not an outside cause to manias. I think they are natural developments. But of course, as you pointed out, we have a central bank that has accommodated all this positive mood and allowed people to go into extreme debt. In fact, we have nearly record margin debt versus free credit balances. People are finding credit wherever they can, and they're throwing it at these mania areas. There's one last thing we should mention. As I'm sure you know, the extreme money creation by the Fed from 2008 to 2022 has recently receded quite a bit. They've contracted their balance sheet by about 15% in the last 2 years, which is unprecedented. I think that's a headwind that the markets are struggling against in trying to hold up.
And yet they are holding up. So, the obvious question is, how long are they going to hold up? I mean, how long can that mania keep going?
Yeah.
It seems like it's been a long time since we've had, I mean, outside of COVID, which we kind of discount the COVID crash, but outside of that, it's been a long time since we've had a serious crash. It was 2008, 9, and 10 since we had a serious crash. That's a long time when it comes to economic cycles. So how long can this go? Can the Fed really do a soft landing and we go on for another 10 years? Or is this bound to come down imminently?
Well, it's not only been quite a few years since we had a recession, a great recession, 2009, et cetera. It's been much longer than that since we've had an undervalued stock market. You have to go back to 1974 and 1982 to see an undervalued stock market. Even at the low in 2009, it was rather highly valued if you look back at the previous 100 years. So your question is a good one. We've been holding up for so long. We're at a point where the S&P and the Dow are yielding only 1.5% in dividends. And at the top day in 1929, the Dow is yielding 2.9%. And it used to be a benchmark. Oh, watch out when it gets under 3%. Well, we've been under 3% for decades. So the extent of the mania, the duration of the mania have all been unprecedented. Now, your question is, when should this thing reverse?
Right.
First of all, you have to recognize, okay, stocks are up. And a lot of people are saying, oh, they're not overvalued. And there's no sign of froth or mania. Let's just look at a few things first. We have 2% cash in mutual funds. It used to be that 4% cash meant they were out of ideas and they had virtually nothing. That would usually a market top. Now we're down to 2%. What does that tell us? It tells us that the managers of these mutual funds can't even imagine a 5 or 10% pullback that they could put money to use in. They said, we've got to be fully invested right now. We just found out from investors' intelligence that the percentage of bears among advisors has fallen to 14.5%. That's the lowest in 4 years. It's lower than it was at the all-time highs for most stocks in 2021. So the extreme optimism among advisors is such that you got to go back even before the greatest overvaluation of all time to find one. The Magnificent Seven, I think it's really down to 6 now that Tesla's been pretty much cut in half. Stocks, these are tech stocks that everybody's crazy about, have essentially zero dividends, no yield at all. Junk bonds are yielding only 2% more than treasury bills. I mean, we could go on and on. So we know that we've got mania conditions and extreme optimism. So what's happened recently? Well, for one thing, the Dow got up to the top of a trend channel that goes all the way back to October 2022. I think that's crucial. It has been bumping its head against the upper line for the last month. VIX, VIX, which is a measure of.
Let me hold you there for a second. Make sure everybody is following this. So what does that mean when it's bumping up? When you talk about that, can you kind of put that in language for people? Pretend nobody knows what we're talking about here.
Well, I think the markets very often adhere to certain structures. And one thing you can count on pretty well is when a market has been within a parallel trend channel for a long period of time, that it's an important marker of the base and the ceiling for the trend. And the Dow climbed very strongly up until January, February, when it hit the upper end of one of these parallel trend channels. Now, that may or may not mean anything, but the fact that it has stayed pretty much right at that line ever since tells me that the market knows that line is there. So I think that's important.
One thing that Robert's talked about, and he's talked with several guests over the last year or so about, is the negative, the inverted yield curve. Historically, that's predicted a recession. Where do you think that's going? And so are we here for another year? Are we here for another 2 years? Or is this imminent during the election, after the election? We'll get to the election in the next segment, but where do you think we are in this cycle?
I don't think I could predict when the inverted yield curve will switch back to a normal relationship. But what we both agree on is that this has been in the past a bearish sign. It's been a harbinger of a bear market. As long as it's in place, I think that fits all the observations we've just been making.
So interesting. So the Fed is meeting later this week, talking about rate cuts. And of course, rate cuts, the rate increases have had a significant impact. You mentioned the drop in commercial real estate, both from in the multi-family space as well as the office space. And certainly real estate investors in particular are looking forward to a rate cut. What do you think is going to happen?
Well, we did a study 25 years ago and demonstrated that all central banks around the world, including the Federal Reserve, do not set interest rate policy at all. Everybody thinks they do, and they like to pretend that they do. But all they do is they follow the market set treasury bill rate of their particular country. You can go back and see that the Fed did not start the latest interest rate rise. Treasury bill rates started to rise on their own, and the Fed, as always, began to follow the rate upwards. Since the Treasury bill rate hasn't done anything but stay flat for the last few months, I'd be rather surprised if they decided to change their federal funds rate in the current meeting, which is, by the way, is today in just an hour or so. So people think they're in control of that, but they're really not. The only thing the Fed really has in terms of policy it controls is the balance sheet.
Got it. So they're followers. They're not leaders.
With a 5-month lag on average.
Okay. Do you see rates coming down this year? I mean, because you're following those market trends, you're following what's going on. It sounds to me like as close as the Fed is following them. What do you see coming in the next 6 to 9 months?
I don't believe that I could give a good answer to where rates are going, but I can give a good answer to what will happen if they go up. We have a serious problem with the federal debt. As you know, well over $30 trillion. The percentage of the government's income that's going to paying interest on its debt has been rising rather rapidly. This is an extremely difficult situation for the federal government. And they, above anyone, certainly want rates lower. But the market's going to be in charge here. And if it decides that, debts are risky, they could start demanding more and more money to make their people's credit available. If that were to happen, I think that would be one of the reasons people would later point to say, oh, that's why we went into a collapse in stock prices. That's why we went into a recession or depression. So I think that is the biggest risk for the economy as a whole, besides the fact that we've got too much debt out there in the first place.
So interesting. You're listening to the Rich Dad Radio Show, the good news and bad news about money. We're going to take a break. We'll be right back. And when we do, we'll talk to Bob Prechter about how do you prepare for a crash and how do you prepare whether it goes up or down? Because if we don't know when it's going to go up and down, we clearly have to prepare both sides. It looks like the market is preparing it for it to only go up, is what I'm hearing so far. And let's look at what can be done if the market does come down and when the market comes down. This is the Rich Dad Radio Show. We'll see you in just a few seconds.
Have you heard about the expanding influence of BRICS, Brazil, Russia, India, China, and South Africa, and its potential to severely impact the US dollar by possibly creating a new world currency? Even JP Morgan said, and I'm paraphrasing, the impact of BRICS would most likely be felt here in the US, where moving away from the dollar would cause our financial assets like our IRAs and 401ks to lose value. We agree with JP Morgan and many others. Now's the time to position yourself for stability, security, and wealth protection. So take it from Robert and me, whether you're a seasoned investor or just starting, we believe that gold should be a part of everyone's portfolio. Seize the opportunity to ensure your financial future with gold and do it with one of the best in the industry, Allegiance Gold. Allegiance Gold has done things right from the beginning, having earned 5 stars with TrustLink and an A+ with the Better Business Bureau. Allegiance Gold can help protect your IRA or 401k with physical gold and silver, or you can have it delivered securely to your doorstep. Get up to $5,000 in free silver on a qualifying investment when you visit protectwithrobert.com today. Or you can call 844-3-ROBERT. That's 844-3-ROBERT. Hi, everyone. I'm Kim Kiyosaki. Thank you for being with us today. As CEO and co-founder of the Rich Dad Company, I can assure you, Robert and I are both dedicated to our Rich Dad mission to elevate the financial well-being of humanity. And you are the humanity. We truly want you to succeed. When you succeed, we all succeed, and our mission grows stronger. With that in mind, I'm excited to extend a personal invitation to you to elevate your financial well-being by attending our exclusive free online wealth building event hosted by Robert. You'll learn what to focus on first to start increasing your cash flow immediately. You can reserve your seat right now by going to richdadonline.com. Just go to richdadonline.com. The event is 100% free and will help you achieve your financial goals.
Hello, hello, hello. We're back. You're listening to the Rich Dad Radio Show, the good news and bad news about money. I'm Tom Wheelwright, Robert Kiyosaki, CPA and tax advisor. And I'm filling in for Robert because he is speaking in Australia and New Zealand, and we're wishing him the best down under. And I have with me today a tremendous guest, Bob Prechter, coined the term socionomics, and we're going to talk about socionomics for the next few minutes when it comes to the election. And how does the election predict? What I want to know, Bob, is not only how does the election predict the economy, but how does the economy predict the election? So start with either one you'd like, and then let's do the flip side.
Okay. Well, we started with the premise that waves of social mood are natural and they do control the society's mood. And we have noticed that the presidential popularity tended to roughly trend with the stock market and social mood. So we said, how can we design a study to test our hypothesis? So back in 2008, my colleagues and I decided that we would study elections in the United States, presidential elections. Now, most studies of presidential elections only went back to the 20s or something like that. But we had data in the stock market going back to the founding of the country. And we also had, we knew who won the elections all the way back to George Washington. So we were able to do a 200 plus year study. And what we did was we related the action in the stock market prior to the election to see if it affected people's mood and therefore who they decided to vote for in the upcoming election. So what we found is very interesting. It didn't seem to affect the outcome if new candidates were involved. But if an incumbent was running, he was heavily laden with the baggage of his previous 4 years, or with the credit for a good 4 years. And when people's mood was up, they smiled on the president and said, let's reelect him. And when their mood was down and the stock market was reflecting that, they would say, let's kick him out and take the opposition. It did not matter which party was involved. So relative to the current election, what I think is interesting is we tested the 2 years prior to the election, 3 years, and 4 years. We postulated that 3 years would probably be the best measure because most people kind of give the first year to the previous person in office, and then that guy takes over and it's all his credit or blame thereafter. And we did find that there was an extremely tight correlation. You could predict with very strong confidence who would win a re-election. Well, it so happens this year we have a re-election set up because Joe Biden has been president for the past 3+ years, and he's going to be running apparently in the fall. So we've also been tracking his popularity, and his popularity seems to have been following the Russell 2000, which is down 16% from the first quarter of 2022, which just happens to be the start of the measuring point, and stocks have been pretty much down since then. So if the stock market heads down, such as we've been talking about the possibility of being very high, that's likely, then his popularity should continue to recede. If the Russell 2000 suddenly, for some reason, picks up steam and trundles up to new highs by November, then he's likely to be reelected. So that's our outlook for now.
Interesting. So you're looking at the broad index, not the narrow index of the Dow, for example, or the NASDAQ compared to the Russell 2000. Because that was interesting. You've got all of these indicators that are out. You just were mentioning in the previous segment that people are all in the stock market. If they're all in the stock market, how is it that President Biden's approval ratings are so low? So is there a disconnect between the market and how people feel in the market versus how people feel in their daily lives?
Yeah, the optimism in the market has been very narrow. And in fact, what I think has been going on, because the Russell is still down 16% while these tech stocks are making new highs, is what investors are really doing is not so much bidding up everything. They're simply swapping. They're saying, I'm
Mm.
getting rid of my mid cap stocks. I don't need those slow movers anymore. I'm going to buy Nvidia and I'm going to buy Google and everything else that's flying. So it's an overstatement. The reports that you read and the magazine covers that you see, such as Bet on the Bull and How High can Markets Go, they're being very selective and they're looking at only the indexes that are making new highs and they're ignoring the ones that are lagging severely, and they're ignoring the selectivity as well. So it's a difficult situation. I mean, we could get into this in more detail because there's also the Dow, for example, divided by the PPI, which is the inflation adjusted Dow Industrial Average, and that is not at a new high. So because of the fact that we have a central bank that can do whatever it wants with the money that we use, it's difficult to track these indexes, but I think that's a good summary right there.
So it sounds to me like, so what I hear on the street, of course, I'm a CPA, so I have clients that are on Main Street, right? My clients are Main Street. They're not Wall Street. And what I hear is that everybody's down across the board. Unless you're Rolex, everybody's down. And so Main Street seems to be down. And what I'm hearing is Russell 2000 would agree with that. Main Street is down. It's just that those NVIDIA and those tech stocks are just so far up that they're kind of counterbalancing the stock market. Now, I find it interesting, and I just want one more minute on this, is Trump is also running as an incumbent in a way. I mean, you have two presidents, or one a current president, one a former president, running against each other. Did you look at what happened? Because we've only had this, I think, one or two other times in the country when you have two incumbents running.
Well, no, but you'll recall that in 2020, we had an extremely sharp crash. The S&P dropped, I think, 37% in 5 weeks. But it was trying to recover going into the election of 2020. But the mood had changed just enough that the incumbent lost. And that fits our theory pretty well. Well, now we would say that he's not an incumbent. Trump was a former president. And people are judging the current incumbent. And I don't think they were thinking much about him. However, there is a little twist, as you pointed out, having been a former president, people can kind of think back and say, well, things were a little better back then than they are now. And I think you're seeing that overtly in a lot of the interviews that we see.
I see that too. So let's quickly shift to, what do you do about this? So we don't know when it's going to happen. You talk about, a crash will happen. Obviously, at some point we think it will, but it just keeps getting postponed. So how do you prepare when you don't know? Do you do what the market's doing, which is put all your money in the market, or do you hold some cash out thinking that, wow, there's going to be some opportunities?
The stance that we've adopted at Elliott Wave International as a recommendation for most people, there are people who want to take plunges in the market and they could be short if they wanted, or, sell futures or something. But for the vast bulk of people, we think the best thing to do is be as calm as possible and as safe as possible. And we have some suggestions along those lines. And one of the things I've been pressing very hard is treasury bills, because they currently yield more than triple the dividend yield of the S&P and the Dow. It's easy money and it's free money. And at least for now, the U.S. government's in pretty good shape. We don't have to worry about the bankruptcy of the government at the moment. So I think it's extremely safe. There's a special way that you can do that, which I've also brought out in the book, Conquer the Crash, which is called floating rate notes. These are 2-year notes, but they're not tied to a 2-year yield. They're tied to the quarterly treasury bill yield. So as treasury bill yields have gone up, the yield in these FRNs has gone up. And as an owner of them, you didn't have to sit around and try to roll them over all the time. You just sit in there for 2 years, and the note itself does all the work for you. So every 2 years, you simply buy a new one and you're all set. We can talk about gold and silver as well.
So basically an adjustable rate mortgage, but you're on the bank side.
Well, I'm on the side of safety. I don't want to get anywhere near mortgages, but
No, what I'm saying is that this is a rate that adjusts, right? It floats. So it's like an adjustable rate mortgage. I mean, a lot of people who were listening to the show, I'm sure, still can remember 2008-9 with those adjustable rate mortgages when they spiked, right? But this is the case where you're doing it on the other side of it. You're now the investor instead. You're the recipient rather than the payer, and that's basically what you're talking about, right? You've got an adjustable rate or a floating rate. So as it goes up, you get the benefit. If it goes down, then your rate comes down.
That's right. It's a great analogy, Tom. And don't forget, some people say, well, what if we get more inflation or what if we get deflation? I happen to think there's a severe risk of deflation because there's an absolute ocean of IOUs out there, quadrillion of them or more. I think that is a tremendous risk. However, if there is more inflation and rates are likely to follow now. They were in this weird sleep for a number of years when rates were down at zero. It never happened before in history, much less negative rates, which we had in some things as well. But now they've woken up, and I think rates are back to normal and saying, yeah, you want to inflate and have prices go up? Well, we're going to go up too. You're going to be paying us not just 5.4%, which is what they yield right now, but maybe 6 or 8 or 10 or 12. Who knows where they could go? And if there's a deflation, there's obviously a floor on these things. And if money starts to become worth more as prices go down or the stock market goes down, you're in perfectly good shape. You're being paid in money that's going up in value. So I think it's really a great place, and safety has rarely been as attractive as it is today.
So tell us again what these are called.
Floating rate notes.
Floating rate notes, and you're talking about a 2-year floating rate note.
Yes. And I explain it in one of the chapters in Conquer the Crash, and tell you how to go about finding these things. They're not widely known, but they've become more known as rates have gone up. People are starting to notice that they exist, which is great. So anybody who reads that book, and by the way, we've got a discount for any of your listeners if they want it, a big one too.
I love that. Tell us about that, Bob, because I know that Rich Dad listeners get a major discount on your book today.
Yeah, we sell it every day for $99, but I think what we're doing is offering it for $37. There's also a couple of free things. If you don't want to spend a nickel, we've got a report about how to deal with difficult times, subscription deals, and so forth. All they have to do is go to the right place online and they can get those.
Oh, that is awesome. Thanks again, Bob Prechter. So final words, Bob, tell us, what are you doing right now? And what are you doing for the next, especially 6 to 9 months personally?
You mean in terms of investments?
Finance. Yep, absolutely. Besides the floating rate notes.
I follow my own advice. So
awesome.
I'm extremely liquid. I think there's also a tremendous potential opportunity, of course, to make money on the downside of the market. So I think it's fine if people want to take a flyer with a small percentage of their total net worth, but I certainly wouldn't put everything on that idea. But oh my gosh, there's so many other reasons we could talk about why the current position right here on the 20th of March, 2024, the markets look so precarious to me pretty much right now. It's amazing. I mean, maybe they'll hold up until the summer. I don't know. But before we go, I'd like to give your listeners that address to go to.
Great. Let's do it. We've got a link in the description, but go ahead.
Okay. Because some people I know just get audio on this. It's ElliottWave.com/richdad. Now, Elliott has 2 L's and 2 T's. Elliott and then wave, like on the ocean.com /richdad. And I think we're going to leave the deal up there for a short period of time because we've never offered the book for that low a price before.
I think that's awesome. Thank you so much, Bob. I have one last question for you. What do you see happening with taxes? Is it going to be as bad as we think it is if the Democrats run the table?
I recently read an article in detail that discussed all of the taxes that the Biden administration wants to impose on the country. So
I know all about this.
It's amazing. And I think it would not be good for business or the economy at all. And of course, we know from his previous 4 years that if Trump gets in, he's probably likely, if anything, to lower taxes. On that narrow topic, that's what you can expect out of the two.
I just had to get that in. I'm a tax guy through and through, and
Yeah.
I just want to thank everybody for listening to the Rich Dad Radio Show, the good news and bad news about money. We'll be right back with my final thoughts, and don't forget the special discount on Bob's book, Conquer the Crash. Hello, hello, hello. You're listening to the Rich Dad Radio Show, the good news and bad news about money. This is Tom Wheelwright, the sub-host for Robert while he's in Australia and New Zealand, speaking down under. And it's just been a pleasure interviewing Bob Prechter. I mean, what an amazing guest and what an amazing mind. And really interesting that he's looking at the election, but he's also looking at, wow, he finally solved an problem for me. So I've been wondering this question, but was talking to my wife earlier about it. And the question is, how can Main Street seem so down and people's moods seem so down, but the stock market so high? And the way he explained it was, it's just narrow. These are just narrow. It's NVIDIA, it's Google, it's the big six. And then you've got Bitcoin and Ethereum are up, but other coins are down. So I think that's really interesting that it does explain a lot as to what's that dichotomy going on in the marketplace right now. I think this is something we have to study. We've got to look at the broader spectrum. We can't just look at the micro, but we've got to look at the macro because that's how we make better decisions. And just by the way, if you'd like more information about taxes and how to find a better CPA, go to wealthability.com. That's wealthability.com. And that is my website. And we have a large group of CPAs that are available to handle tax advisory work and tax return work for entrepreneurs and investors. So it's been my pleasure to be with you on the Rich Dad Radio Show, the good news, bad news about money. It's always a pleasure with Robert at any time, even when he's in Australia and I'm here in Phoenix, Arizona. Thanks so much for joining us on the Rich Dad Radio Show.
This podcast is a presentation of Rich Dad Media Network.